Hello traders, and welcome back to the ComLucro channel. In today's chapter of our course, Technical Analysis for Day Traders, from Basics to Advanced, we're covering one of the foundations of trading, support and resistance. These aren't just lines on a chart, they're key decision zones that can greatly improve your entries, exits, and overall confidence. But before we dive into the charts, let's talk mindset. Because no strategy works if you can't control your emotions. As Larry Williams says, trading success depends on staying calm under pressure and thinking before you react.
Do you have the right stuff to become a trader or an investor? Frankly, I doubt it. A dear friend of mine, Jim Irwin, was the first astronaut to drive a car on the moon. I asked Jim how he got selected to become an astronaut. What process did they go through? He said the big tests were on how much stress we could handle. And to learn to handle stress, they had to repeat the same function over and over. Things would change. They'd have to learn to respond to it. That's what traders do and investors do. We're always responding to something that we don't have a lot of control over, just like the astronauts. So if you don't handle stress well, if you get emotional, you respond too quickly, this is not for you. Pack up your computer, stop trading. You're going to lose money. I don't want that to happen to you. Or learn to handle stress, to stop, to think before you react. Most people that are not making money react too quickly. Instead of cooling off a little bit, thinking about it, they jump to conclusions. This is not a business where you want to jump to conclusions.
That's exactly what support and resistance give you. A clear structure to pause, think, and respond instead of reacting impulsively. With that mindset set, let's get practical. In this video, we'll break down what support and resistance truly mean, why they're vital in technical analysis, and how to use them to sharpen your decisions. We'll cover key tools, from horizontal levels and trend lines to moving averages and Fibonacci retracements, to help you spot where price is likely to stall, reverse, or break through. You'll also see how these levels shape market behavior, from reversals to breakouts and range trading. It's a focus session designed for day traders who want structure and clarity in fast-moving markets. So if you like this kind of video, please like, subscribe, and turn on notifications. And join the ComLucro community to support the channel and keep improving as a trader. Now let's jump in and get started. Support is a price level where a downtrend tends to pause or reverse. At this level, demand increases as buyers step in to prevent the price from falling further. Think of support as a sturdy floor beneath the price, providing a strong base that keeps the market from dropping too low. Resistance, on the other hand, represents a price level where an uptrend tends to pause or reverse. When the price reaches this level, selling pressure builds, making it challenging for the asset to continue climbing. Resistance acts like a ceiling above the price, capping any further upward movement and signaling a potential reversal. Now, let's distinguish between these levels and the broader zones of supply and demand. While support is a specific point on a chart, a demand zone is a broader area where buying interest is strong enough to halt a decline. This zone covers a range of prices where buyers accumulate positions, anticipating a price reversal due to increased demand. So, while support acts as a precise safety net, a demand zone provides a wider cushion, offering protection over a broader area. Similarly, resistance differs from a supply zone. Resistance is a defined level where the price struggles to move higher, whereas a supply zone covers a range of prices where selling pressure is significant enough to stop an upward movement. In this zone, sellers are active, expecting that the price will not easily break through. Therefore, while resistance serves as a specific barrier, a supply zone spreads that resistance across a wider range. However, one of the biggest mistakes traders make is assuming that the price will never break through a support or resistance area, or conversely, believing that once a level is broken, the price will automatically continue in that direction. It's crucial to understand that the market does what it wants, and it's not bound by any guarantees. The key to navigating this uncertainty lies in having solid risk management and emotional control. As the saying goes, the market can remain irrational longer than you can remain solvent, a quote often attributed to John Maynard Keynes. Additionally, one of the major shortcomings of many videos and materials focused solely on technical analysis is the lack of emphasis on a critical truth. Trading is about probabilities, not certainties. Success in trading doesn't come from being right all the time, but from how well you manage your trades when things don't go as expected. That's where risk management, emotional discipline, and patience come in, not just as optional skills, but as core elements of long-term consistency. To reinforce that, here's a brilliant perspective from Charles Faulkner, one of the key contributors to the Market Wizard series, on how professional traders think differently about loss and decision-making under pressure.
If you were making decisions, imagine if every decision you made was like, oh God, I'm making the decision, it's really important. And you're doing this, and you're getting all upset about this decision. I mean, does that make it a better decision? Here's the thing, when you get into the trading, a number of people have this idea that if they're trading big amounts of money and putting on positions, therefore it ought to be really exciting and upsetting because of all the stuff involved. But the people who do it really well are minimizing risk. For them, it's pretty much the same thing. Now, understand, sometimes there's also confusion about this in terms of cutting losses. The neophyte trader, when he hears cut your losses, will try to cut them to zero. Even if it means waiting for it to go down, waiting for it to come up again, right? And then it goes down. Well, it'll come back because I don't want to take a loss. Which is different from the experienced trader who's going, I cut my losses. I never eliminate them. I just keep cutting them and cutting them and cutting them. So the idea is you never eliminate risk. You're minimizing risk.
To dive deeper into this concept, check out the video that will appear in the card about liquidity from our Smart Money course. Although it's more advanced for this stage of the course, it's valuable to watch and start thinking about these concepts now. Moving on, let's continue by diving into the various techniques traders use to identify support and resistance levels. We'll explore each method in detail, starting with the simplest approach and moving on to more advanced techniques. Before you begin identifying these levels, it's crucial to start by analyzing higher time frames and then work your way down. For day traders, this means starting with the weekly chart, then moving to the daily, hourly, 15-minute, and finally the 5-minute chart. This approach is essential because support and resistance areas on higher time frames tend to hold greater significance and can strongly influence price action on lower time frames. However, to keep this video more focused and efficient, we'll demonstrate the drawing of these levels using a single time frame. Now, let's identify and draw these levels. Begin by locating key reversal points on your chart. These are the areas where the price has repeatedly changed direction. Using the horizontal line tool in TradingView, draw a line at the price point where the market has consistently reversed upward to mark your support level. Similarly, identify where the price has struggled to move higher and place another line there to indicate resistance. It's important to refine these lines as you move to lower time frames, adjusting them slightly if necessary to capture the most accurate levels of support and resistance. You can also label these lines for clarity. Add labels like support or resistance. By following this top-down approach and focusing on key levels across multiple time frames, you'll gain a clearer understanding of market dynamics, allowing you to make more informed trading decisions. Now, moving on to trend lines. To draw trend lines, start by identifying the highs and lows of price movements on your chart. To create an upward trend line, connect a series of higher lows. This line will act as a support level, indicating where the price is likely to find buying interest as it rises. Conversely, to draw a downward trend line, connect a series of lower highs. This will serve as a resistance level, showing where selling pressure typically emerges during a decline. These trend lines are particularly valuable in trending markets, as they help you visualize the overall direction and momentum of the price. Make sure to adjust the lines as needed to accurately reflect the key turning points in the market. By following these steps, you'll have a clear view of the trend, aiding in your trading decisions. Next, let's discuss moving averages. Moving averages, particularly the 20, 50, and 200 period averages, can act as dynamic support or resistance levels. To begin, apply the moving average indicator to your chart, selecting the desired period. When the price is above the moving average, it often serves as a support level, indicating that the price is likely to find buying interest if it approaches the average. Conversely, when the price is below the moving average, it can act as a resistance level where selling pressure may occur as the price rises towards the average. Traders often rely on these moving averages in trending markets to identify key levels where the price might react, helping to guide entry and exit points. Adjust the period of the moving average to suit your trading style and time frame, ensuring it aligns with the market conditions you're analyzing. Moving on to psychological levels. Round numbers, such as 100 or 1000, often act as significant support or resistance levels. These levels are important because they attract the attention of many traders, who tend to place buy or sell orders around these figures. This concentration of orders can lead to increased buying pressure when the price approaches a psychological support level, or heightened selling pressure when it nears a psychological resistance level. Recognizing these key levels can help you anticipate potential market reactions and adjust your trading strategy accordingly. Finally, let's look at Fibonacci retracement levels. These levels, calculated based on the Fibonacci sequence, are key areas where price retracement might occur within a trend. Common Fibonacci levels, such as 38.2%, 50%, and 61.8%, are widely used by traders to identify potential support and resistance points. To apply Fibonacci retracement, select the tool in your charting software, like TradingView, and draw it from the start of a trend, a significant high or low, to the end of the trend. The resulting horizontal lines at the Fibonacci levels will indicate areas where the price might pause or reverse during a pullback. These levels are especially useful for anticipating where the price might find support or resistance as it retraces within a trending market, helping you make more informed trading decisions. As you've noticed, there are various ways to draw support and resistance on your charts, and this can often complicate and hinder the learning process. Many beginner traders find themselves jumping from one method to another, which can lead to confusion and inconsistency. The key is to understand how each method works and then decide which approach best fits your trading strategy. We strongly recommend that you avoid cluttering your chart with multiple support and resistance lines, trend lines, Fibonacci levels, and moving averages all at once. Doing so can make your chart overwhelming and difficult to interpret. The goal of this video is to introduce you to the different possibilities that trading offers, so you can explore them. It's important to note that in future chapters of our course, we will dive deeper into specific strategies for what we consider to be the best ways to trade using support and resistance. With that perspective in mind, let's move forward and explore how support and resistance levels play a crucial role across different market scenarios. First, let's discuss price reversals. These are key moments where the price changes direction, often occurring at support or resistance levels. When the price approaches a support level, it may bounce back up, signaling a potential reversal of the downtrend. Similarly, when the price nears a resistance level, it might reverse downward, indicating the end of an uptrend. To identify these reversals, traders often look for specific patterns such as double tops or double bottoms. A double top at a resistance level suggests that the price is struggling to break higher and may soon decline. Conversely, a double bottom at a support level indicates that the price is finding it difficult to fall further and might start rising. By recognizing these patterns and understanding how price reversals work, you can better anticipate market movements and make more informed trading decisions. Now let's consider trading ranges. In a sideways or consolidating market, prices tend to move within a well-defined range bounded by support and resistance levels. During these periods, the market lacks a clear trend and prices fluctuate between these boundaries. Traders can capitalize on this by buying when the price is near the support level and selling when it approaches the resistance level, taking advantage of the predictable price movements within the range to generate profits. Next, let's move on to breakouts. A breakout occurs when the price pushes through a support or resistance level, often resulting in significant price movements. When the price breaks above a resistance level, it can signal the beginning of a new uptrend, suggesting that buyers are gaining control and the market is likely to rise further. On the other hand, a breakdown below a support level might indicate the start of a downtrend. With sellers taking charge and the price expected to fall, traders typically view these breakouts as opportunities to enter trades, anticipating that the price will continue in the direction of the breakout. By understanding and identifying breakouts, you can capitalize on these shifts in market momentum. Moving forward, let's talk about false breakouts. Sometimes the price may temporarily move beyond a support or resistance level, only to quickly reverse back within the range. These false breakouts, also known as springs, liquidity sweeps, or stop hunts, can trap traders who anticipated a sustained move, leading to premature entries or exits. It's crucial to recognize the signs of a false breakout to avoid being caught in these deceptive moves, and to ensure that your trading decisions are based on more reliable signals. Now let's discuss risk management. Effective risk management is essential for successful trading and is closely tied to support and resistance levels. Traders often place stop-loss orders just below support or above resistance levels to protect themselves from unexpected price movements. By setting these stops strategically, you can limit potential losses and ensure a controlled exit if the market moves against your expectations. This approach not only helps to define your risk, but also allows you to trade with greater confidence, knowing that your downside is managed. Finally, let's touch on market sentiment. The interaction between price action and support and resistance levels provides valuable insights into overall market sentiment. If the price repeatedly tests a support level without breaking it, this could indicate strong buying interest and bullish sentiment. Conversely, if the price struggles to break through a resistance level, it may suggest dominant selling pressure, signaling bearish sentiment. Understanding this dynamic helps you gauge the market's mood and adjust your trading strategies accordingly. In conclusion, mastering support and resistance is a foundational skill that can significantly enhance your trading decisions. Whether you're identifying key levels for price reversals, navigating breakouts, or managing risk, understanding these concepts is crucial for success. We've covered different methods to identify levels like trend lines, moving averages, and Fibonacci retracements. The key is to keep your charts clean and use the tools that fit your strategy. As you refine your approach, remember, trading is about probabilities. Combining technical analysis, risk management, and market sentiment will help you make informed decisions and succeed. Please also remember that our mission here on the ComLucro channel is to give traders the clarity and confidence they need to make smarter decisions in the market. Every video, every course, and every piece of content we create has one clear purpose: to deliver practical, easy-to-apply knowledge that helps you grow step by step as a trader. Here on the channel, you'll find complete courses on smart money concepts, technical analysis for day traders, and trading psychology. Because trading isn't just about charts, it's also about mindset, discipline, and risk management. We also share lessons and insights from some of the most respected names in trading, professionals like David Paul, Alexander Elder, Tom Hugard, Mark Douglas, Al Brooks, Larry Williams, and many others whose experience has shaped the way we understand the markets today. If you enjoyed this video and found it helpful, please give it a like. It really helps more traders discover our content. And don't forget to subscribe and turn on notifications so you never miss our latest insights and strategies. If you'd like to go even deeper and access exclusive content, early video releases, and additional tools to support your development, consider joining the ComLucro trader community right here on YouTube. It's a simple way to support our work and a smart investment in your own growth as a trader. Thanks for watching, and I'll see you in the next video.